So the last time we started looking at tax avoidance and tax evasion, I mentioned that it's a popular area that the examiner likes examining. Remember, at the final level, we have the opportunity to only examine students for 15 questions. And it is a final, so you're supposed to be a master of all tax issues. But then there are some specific areas that you can't avoid. Some things like tax avoidance and tax evasion, especially discussing the relevant provisions of the law. You should be able to pick some of the tax laws and point out and tell us that this is anti-avoidance provision. So we looked at the general anti-avoidance. We said that they are general in the sense that it gives the Commissioner General the discretionary powers to be able to apply the law anytime he is of the opinion or he thinks that the taxpayer has engaged in a tax avoidance. You cannot discuss tax avoidance without discussing what the meaning of tax avoidance is. Okay. And so section the 99 of the Revenue Administration Act that we looked at, it is very important. You need to look at what exactly do we mean when we say tax avoidance. Sometimes we can also ask you to distinguish between tax planning and tax avoidance. Okay. So you need to pay attention to the provisions of the law. What does our law says, especially when it comes to the anti-avoidance provision? So we look at the general anti-avoidance, we say section 99 and then section 34. They are very specific. We also look at the specific anti-avoidance. Why do we call them specific? We are saying that they are specific because we know exactly what they are. We have observed over time that it's a pattern. Taxpayers like that particular behavior. So we not anti-avoidance provisions to be able to deal with those suspected tax avoidance. And anytime you are discussing the specific ones, you need to be able to tell us the provisions and what it says. So we started looking at thing capitalization. Here, please be careful with section 33 because it's either you discuss it or a calculation will be given to you. So we'll give you the calculation and then we ask you to apply the thing capitalization rule. In the slides I shared with you, there was a particular question like that I asked you to solve. I think the solution is also in there. Because of time, we've already discussed it. So look at it when we get to our revision and we are discussing them, and then we can pick some of those thing capitalization questions then we looked at. Please, I'm expecting students to be able to take notes. You have to be making your short notes. You can't prepare for professional exams like CITG, and then you just be listening, probably lying down or doing multitasking. So my expectation is that you should be making some notes. Strategic tax planning, there will be calculations along the line, but largely it's going to be discussion and especially looking at the law. So please, you should be making small notes for yourself. We look at anybody has a question? Or somebody asking a question? Okay, please, if you want to ask a question, you raise your hand. And if I don't know, someone was talking. I don't know whether it was a question or not. We also look at thing capitalization. No, we look at, please, where did we get to? Can somebody remind me? Just pick your notes and let me know where we got to. Kevin, do you know where we got to? Anybody online?
Hello, sir.
Yeah, which anti-avoidance did you discuss in our last?
Yes, you were talking on 10 capitalization, section 33, and that was where you were. I think where you ended, you were talking about the policy rationale, debt to equity ratio, and you were giving regulatory response is 3:1. That was where you ended.
Okay, that's fine. Thanks. So it means that we've not gone far. Maybe let's try and finish up all the anti-avoidance provisions today, and then we'll move. So the policy rationale was that people or taxpayers are capable of abusing Section 10. You remember Section 10 allows anybody, any business person who borrows money to deduct the interest on the loan, on the borrow. However, you realize that if I were a multinational or a parent company, I can use loans to avoid so much tax, such that if Section 10 of the Income Tax Act allows me to deduct interest, instead of me putting my money as equity, I can do it as a loan. And finance people will tell you that the capital structure is thin. We know that 10 capital structure is not good. It's highly geared. Nobody will want to invest in it. So in substance, if it was a bank, even a bank will not even give you a loan. So if you are even applying Section 34 of the 896, which is anti-avoidance, you will realize that the substance over form principle will not even work. Who will do a capital structure of 90% loan and then 10% equity? Nobody will do that. No serious-minded business will do that. Or maybe 99% loan. And you are doing that because you know very well that Section 10 allows you to deduct interest. So every tax authority will say they will not allow you to be abusing the law like that. So we came out with a ratio. It used to be 2:1 under 592. Then under 896, we changed it to 3:1. I don't know who suggested that we should do it 3:1. But if you read around the globe, most tax authorities, when they are dealing with 10 capitalization, they use 3:1 ratio. Maybe you can write an article and say that we should move it to 1:4 or 4:1 or whichever ratio you suggest. And you have to come out with your policy rationale. I think it will be good. Okay. So that's where we ended. And like I was saying, Section 33, please watch out. There are either we ask you to explain the concept or we'll give you a calculation. So we'll give you the capital structure and then we'll tell you that the loan has been given and interest has been given. Then we ask you what is the tax implication? Or some of the questions we can ask it, we can do it this way, that the businessman wants to expand his business. He can either do it through injection of equity capital, or we can even decide not to ask you. A businessman wants to expand his business to take advantage of, let's say, one district, one factory. And what are the various financing options available to him? What will you say? You can advise him that he can go for bank loan, or he can even use his own money to invest. And then we'll give you some small scenarios. And we want to test your understanding of thin capitalization. What implications would be if this guy decides to give a loan, or if the parent company decides to give intercompany loan. What is the implication for that? All right. So any question on think up before we come to section 32? Is everybody fine with thin capitalization? Can you answer a question on it, either calculation or written? Going? Thank you. We are gone. Let's come to section 32. Section 32 deals with income splitting. And you see, if you have a tax regime, am I alive?
Yes, sir.
Yes, you are.
Okay. Everybody is quiet. That's why I'm wondering. No question. Oh, and I'm going to say.
We are taking notes.
Okay, good. Take notes because you never know. You can meet it somewhere. Remember, this is your final level. When you leave here, no, you should be able to advise Bank of Ghana, you should be able to advise Societe Generale and everybody using the law. Okay, let's come to income splitting. It's also one of the anti-avoidance provisions. Again, the rationale is that we are introducing this one so that anybody who attempts to split his income, we will use this law to counter it. If you have a tax regime where, for example, some companies pay lower tax than the others, if you have a tax regime where an individual will have a graduated rate, or you have a tax regime where some entities are even tax exempt, okay, because of maybe their location, then you should be careful that if you have a smart tax consultant, that guy will not allow the company to pay any tax. Why? Assuming I have a company in Accra, what is the corporate tax rate?
25.
25. Good. Then I have another entity, let's say in the free zone. Let me not even use free zone. Free zone, I'm going to a different law. I have another entity in the northern region, established, a subsidiary, established in the northern region. You know, those savannah people, because of the way that place is underdeveloped, we try to use some tax policy to move the companies to those areas. So location-wise, if it is a manufacturing company, if they are located in those areas, their tax rate is different, isn't it? So if I have these two companies and I realize that Accra Tema has a higher tax rate, and I'm dealing with that my subsidiary in, let's say, Tamale, I can use the location incentive to move some of the money from Accra company to the company in the north. In other words, if there is anything at all and I'm able to split the income of the group, or I'm able to shift some of the income from Accra to Tamale, at the end of the day, I'll be able to reduce the overall corporate tax, even though we are still in Ghana. This is not transfer pricing matter. I'm splitting the income. Let me give you another example. A father and a son who has just completed secondary school, who is not even has no working experience, can be employed. If I employ this son, I will be able to split my 50,000 Ghana cedis. You know, 50,000, if you earn 50,000 today in Ghana, you pay the highest corporate tax rate of 35%. So why don't I split that 50,000 money that I intend to pay myself with my 3 children? At the end of the day, even if I give everybody 15,000, the two of them will be 30,000. Then me, I will pay myself 20,000. At the end of the day, I still come back to 50,000. By splitting the income, I'm able to minimize the overall tax liability. After all, these are my children, and the money will come to the house anyway. So, Section 32 seeks to prevent any form of splitting of income. And indeed, this income splitting is even very prevalent in trusts. Trust, people who set up trust. In Ghana, we don't have a lot of people setting up trust. Most people die without making a will. But if you go to some other jurisdictions, the trust is a serious company that people use to manage their tax affairs. So Section 32 says that where a person attempts to split income with another person, the Commissioner General may, by notice in writing to that person, prevent a reduction in tax payable. Please, can you see my screen?
Yes, sir.
Good. So if you attempt to split the income, the Commissioner General will have to prevent it. He will not allow you. So you realize that, like the two examples I've given, you are trying to do income splitting with your son or income splitting with your subsidiary who has a location or lower tax rate. That case, the Commissioner General will come in and prevent you from doing that. Subsection 2 says the Commissioner General may, in the notice referred to in subsection 1, adjust the amount to be included in or deducted from income for the purpose of calculating the income of each person. So maybe you think that I want to split the income by allocating more money or more income to the Tamale branch because they have a location incentives, or you want to do it in such a way that it is through an expense. The Commissioner General can reallocate it. He can adjust it. Or in some cases, B says he can recharacterize the whole thing. He can even recharacterize the source. And in some cases, it can even be recharacterized from employment income to business income, or whichever way. Or he can even recharacterize a loan to equity. So in fact, he has power to do a lot of things. Anytime he suspects that there is some way of tax avoidance, so he can recharacterize the source and the type of any income loss, amount, or payable, or whichever it is. 3 says a reference to a person attempting to split income includes reference to an arrangement between associated persons. For the transfer of an asset, you can transfer an asset And in the end, you realize that it is an income splitting strategy. And it can be direct or indirect. B says where the transferor retains legal or implicit right to benefit from the assets currently or in the future. Normally, this happens with trust. You transfer the thing, but you are still holding it. You are transferring the legal title. But in the end, you see that you are the person benefiting from it. I'm giving the house to my son, or I've given it to my trust, my NGO. By the end of the day, I am the one still benefiting from it. It can take any form. C says where one of the reasons of the transfer is to lower the tax payable by an associated person. The Commissioner General has the power to do this. So please, when an income splitting question comes, again, look at what the law says and then tell us what the Commissioner will do. All right. That is income splitting. It's one of the anti-avoidance. So far we've discussed the two general anti-avoidance provisions, section 99 and 34. Section 33, we've looked at it as thing capitalization, and we'll look at section 32 also as income splitting strategy by taxpayers. Let's look at section 31. Any question?
Sir.
Yeah.
This with the example that you gave between the Accra company and a subsidiary in Tamale. Now, would it be in the form of capital injection?
No. Capital injection as in equity.
Yeah.
No. If you are going to what income? What is income there?
That's the income splitting, the income that you're moving from Accra company to the Tamale office in order to avoid or minimize the tax in Accra.
Or if it is equity, you are putting in equity, so it won't have any tax implication. Maybe if you are looking at it, right, to be thing capitalization.
Okay.
But for example, you want to transfer an asset from Accra to Tamale. You know, if you transfer an asset, it can amount to a sale of an asset and disposal of what they call an asset, isn't it? Depending, it can even, if it is building or land, it can even result in capital gains, isn't it?
Yeah.
Or maybe there is some money that the Tamale office did not actually do anything, but you want to split it anyway. You want to move some of the money there anyway. Some sales have been allocated to them anyway. Or some expenses that is supposed to come to Tamale, then you intentionally bring it to Accra in order to reduce Accra profit, knowing very well that this thing is not an Accra expenses. You see, the main reason is that you want to take advantage of the combined tax effect, because you know Tamale does not pay tax, or they pay tax at a lower rate. It is better to have more profit over there. Is that not it?
Yes.
Okay.
All right. Thank you.
All right. All right. So arm's length. Normally we call this one transfer pricing. How many of you have done the transfer pricing advanced diploma? Mami is doing it. I know Mami is doing it. Any other person? Okay, when you finish, you have to come and do it too, because trust me. What you did, is Mami online? She's quiet, or she's doing pepper soup. Mami?
I'm right here.
Okay. I'm not advising your colleagues to come and do the advanced diploma.
Oh, okay.
Because what you did, oh, Mami, the way you say,
Oh, no. It's not about you. Like, as in, I'm responding to you. Sorry.
okay. I thought you wanted to
Yeah,
discourage
it's
them.
true. Oh, no. I can't discourage them. I do. I mean,
The course is it difficult?
Oh, no, it's not. It's relatable. I
I
mean,
like it. I like this one.
yeah.
I like this one. So arm's length suggests that it should be at full arm. Your full arm. And the connotation is that if somebody is closer to you, you don't need to stretch your arms. If somebody is associated to you, your wife, your husband, your child, if they come to your shop to buy, certainly you're not going to sell at the same price to somebody you don't know. At most, what you can do is that you sell to him at cost. But remember, for tax purposes, your relationship should not influence the tax. So why should you sell to your related party in Nigeria at cost when you can sell to him at cost plus a profit? If we allow you to continue selling at cost and you don't make any profit at all, in the end, you will be looking for places where the tax rate is lower and then be shifting all the profit to that place because over there, the tax is smaller. So you can use, in fact, transfer pricing is a potential tax abuse tool in the hands of mostly multinationals, or if the transaction crosses border. So the arm's length standard, in fact, it is a standard that has been set, and we expect you to meet that standard. And normally it happens between associates, persons who are in control relationship, persons who are related. I know you learned this thing more in paper 9, but over here, we'll be testing your knowledge on what the rule says. So section 31 says where an arrangement exists between persons who are in control relationship, the person shall calculate their income and tax payable according to the arm's length standard. Remember, the arm's length standard is the standard that has been set and has been agreed by majority of countries that it is the standard. What is that standard? Section 2, subsection 2 says that the arm's length standard requires that persons who are in control relationship to quantify, characterize, apportion, and allocate amounts to be included in or deducted from income to reflect an arrangement that would have been made between independent persons. So that is the standard. What is the arm's length standard, if we ask you? So it is a standard that requires that if you are in a control relationship, if you are quantifying or you are characterizing or you are apportioning or you are calculating your amount, that must be included or must be deducted from your tax calculation. It should be done in such a way that it reflects what would have been done if the two of you were independent entities. It's a simple standard, but trust me, it's a difficult one to comply with. Now, if you fail to meet this standard, if your pricing does not, or if your transaction does not reflect this independent status transaction, the Commissioner General is permitted to adjust. And that's what we call the transfer pricing adjustment. Subsection 3 says that the minister may, by legislative instrument, make regulations on matters relating to transfer pricing and the application of the arm's length standard. So, at this level, we'll not be asking you more of transfer pricing and all those things, but we want you to discuss some of the anti-avoidance provisions. So through subsection 3, we now have the transfer pricing regulations, LI 2420, which we are using. Okay. 4 says that where, in the opinion of the Commissioner General, a person has failed to comply with subsection 1, that is the arm's length standard, the Commissioner General may make adjustments consistent with subsection 2. So you fail to comply with it, the Commissioner General is empowered to make the adjustment so that it will reflect the arm's length standard or the market price, if you want to use loose terms. Subsection 5 says that the Commissioner General may, in carrying out an adjustment in subsection 4, recharacterize an arrangement made between persons who are in control relationship, including recharacterizing debt financing as equity. So you see the power the Commissioner General has. Anytime there is a transfer pricing issue, please, the Commissioner General has the power to, recharacterize the transaction. B says recharacterize the source and type of any income loss, amount of payment, and apportion and allocate expenditure, including the activities specified in section 107, subsection 2, based on turnover. Section 107 deals with branch and permanent establishments, and we are capable of doing that. If we think that you have engaged in transfer mispricing, and therefore the arm's length standard has not been met. Any question? Before we move to the other anti-avoidance provisions. Any question? How many do we have now? How many do you have? Hey, am I back online? I'm talking to myself. Sarah.
So you're online.
Yeah, how many do you have now? We should have about 7. If you go and
But we've done the thing capitalization, we've done income splitting, we've done arm's length.
Mhm.
We have
So
the general anti-avoidance rule.
Do you have up to 7?
It's not up to 7.
You need like 7. It depends. Maybe depending on the mark. If the question comes for 20 marks, then you have to write. Maybe if the examiner restricts you to maybe 5, but at least you have 7 of the anti-avoidance provisions in your pocket. So that if you go and forget to cry 9, 5 can be made available to the examiner.
Yeah, because there's change in control, there's undistributed profits of companies and all that.
How many have we done so far?
So far,
I think we've done 4, 5.
We've done
Okay.
4.
Because we've done general anti-avoidance rule, we've done the thing capital, we've done the income splitting, and then the arm's length.
Let's add few more. Let's add few more. You remember that when we're doing when we're doing tax avoidance under Section 99, the meaning of tax avoidance or tax benefits. Yeah, tax benefit. We said that tax benefiting means avoiding. That is, you want to avoid a tax or reducing. If you are reducing your tax, it's a tax avoidance. Or postponing a tax liability. And I want you to focus on the postponement of the tax liability. After all, if you die before the GRA catches you, we will not, they won't assess you. I know of some companies who have wound up, they folded up. Any tax liability they had, they didn't pay. It's gone. But always remember that when we talk about tax avoidance, we say only if it involves a misuse or abuse of a tax law. So let's focus on postponement of the tax liability and let's read Section 18, subsection 3. Change in accounting date. That's the next anti-avoidance provision we want to check. Changes in accounting date. Section 18, subsection 3. Now, 18 deals with year of assessment and basis period. You remember we mentioned that the GRA, their main duty is what? Identify taxpayers. In fact, that is paramount in every tax administration. First, identify the taxpayers by allocating the tax identification number. So everybody, if you are an individual, yours is what? Ghana card. You know, so. And then if you're a company, you have your company term. After identification, the next thing they do is they assess the taxpayer. So the assessment, that is the calculation. The assessment is done on a yearly basis. So that's why we have year of assessment. So we have 2022 year of assessment, 2021 year of assessment. Even if your accounting year starts from June to July, you know some companies, the accounting year starts from 1st July to 30th June. That is their year of assessment. Instead of they doing December, they do June. Now, within that year of assessment, we have basis period, the period, the various months. Sometimes it can even be a day. You understand? So we want to look at how can you use this year of assessment and basis periods to postpone your tax liability. Okay. So how can you use your basis period and year of assessment to postpone your tax liability? Section 1 says that, Section 18, subsection 1 says that the year of assessment for a person is a calendar year. And person here, we are talking about both natural and artificial person, so company. So the government calendar year is everybody's year of assessment. Okay, so if we are talking about 2022, that's 2022 year of assessment. Everybody, the whole Ghana. When we enter 2022, we've entered 2022. Maybe your period will end faster. So as we speak, those who are using 1st July to 30th June, their year of assessment for 2024 has ended. Those of us using 1st January to December, we are yet to close our year. So the year of assessment is the calendar year. 2 says the basis period of a person is A in the case of an individual or partnership, the calendar year. So you and I, the calendar year is January to December. That's the calendar year. Okay. So January to December becomes our basis period. So if I am paying tax, I cannot say my year has ended on 30th June. No, because I'm an individual or even partnership. Remember, partnership, they are also assessed as individuals because partnership firms don't pay tax. Partnership is just individuals coming together. If you look at the partnership law, so the partnership and individuals, they are the same. We all do the calendar year. Now, B says in the case of a company or a trust, the accounting year of the company or the trust. So if you're a company, you can choose your accounting year from, let's say, July to June, we will allow you, or January to December, we will allow you. But they can use subsection 3 to postpone their tax liability. Ask me why. So I have chosen January to December as my basis period. Okay. Which means that if I have any tax payable, I'm supposed to pay within January to December. Then by 30th April, I'm supposed to file my returns. Is that also equal? Akuka? By 30th April, I'm supposed to file my returns.
Yes,
But yes, Akuka, read subsection 3 and let's see how companies can use that one to postpone their tax liability. Subsection 3 says what?
okay. Subsection 3 of the section 18 says the Commissioner General may, on application by a trust or company, approve a change of accounting year of the trust or company on the terms and conditions that the Commissioner General may approve.
Correct. So if you choose your accounting year, you are not supposed to change it. I think that there is a similar provision in accounting. Alain, can you change your accounting year and accounting policies every year and often? I'm with you.
Come again, please. I was distracted.
Can you change your accounting year often?
No, you can't change your accounting year often, please.
Why can't I? The company is mine. Why can't I change it? Is there any law that says that I can't change it? Cynthia or Daniel Upon, is there any law that says I can't change it?
Yes, please.
Thank you very much. First of all, you accountants, you have a policy that says that
Yes.
you cannot change your accounting policies. That is accounting policies, changes in accounting estimate and errors.
Yeah, that's IS 8.
Correct. You can't change it anyhow. If you choose it,
yes,
there must be compelling reason why you want to change your accounting policy. So the Commissioner General is also saying that if you have chosen one accounting year, you can't change it. The reason is that if you decide and say, if you come and tell us that your accounting year is January to December, then there's some tax liability that you are supposed to pay by December. Then all of a sudden, in fact, December is supposed to be your year end. Then all of a sudden, then you say, now my accounting year is June. So then you will continue up to June. Then you close your year. Then maybe we get to June. No, you say, I want to go back to January. If there were no rules guiding, in fact, accounting policies, they are policies. They are not, if you break them, nobody will arrest you. So the Commissioner General is saying that the possibility of people using that changes in accounting date and accounting year to postpone tax liability is high. And therefore, if you intend to change, especially if you're a company, as for individuals and partners, hours, you can't even change it. January to December, it's fixed. The calendar year, fixed. But if you're a company or a trust and you want to change your accounting policy, you have to do that through an application. And the Commissioner General may, on application by a trust or company, approve a change of the accounting year of the trust or company on the terms and conditions that the Commissioner General may approve. To come out with terms and conditions first. 4 says that the Commissioner General may revoke an approval granted under subsection 3 if the trust or company fails to comply with the conditions attached to the approval. So, if I was a company and I don't want to pay some huge tax liability at the end of the year, if it had not been section 18, subsection 3, I would have been able to do what? Avoid paying taxes. Are we on the same page? Any question? Who doesn't understand something? How many do we have? So we are looking for 7. Yes, madam.
Sir,
Yes,
please,
sir.
so how does it affect somebody trying to evade the tax?
So let's say December, I'm supposed to pay a huge tax liability. Is it Bonzi who asked the question? Ruth. Ruth, are you the one?
Yes, please. Yes, please.
So Ruth, let's discuss this. So you have some huge tax liability that you're supposed to pay in December because your accounting year is January to December. Then the board of directors or the chairman of Ruth International Ruth Oil Company says that let's change the accounting date and push it forward. After all, our year has not ended yet. Then you change the accounting year from December to June. Haven't you at least postponed the tax liability by 6 more months, Ruth?
Oh, okay. And I get it. Okay.
Good. And if you come to a tax benefit as we define under Section 99, you've postponed it. Maybe by the time you withdraw or not, you have folded up and gone. Will we get the money?
Yeah. No.
Hmm.
Okay, and I get it. Thank you.
Okay. So Ruth, I'm engaging you again. Let's go to another anti-avoidance. Let's go to section 50. Yes, sir.
Please, before you fold up and leave the country, now you have to settle your scores with immigration.
Immigration.
So
It's a company.
Yes, because the directors would never have to leave the country.
Charlie,
And if they are
immigration, are you saying Massa me kokra? How will you even know? The immigration, maybe what you have said will be an ideal situation in a perfect environment. But if you are traveling with the immigration check, no sense. Unless the Commissioner General alerts them under the Revenue Administration Act when they think that revenue is at risk. That's where they will inform the immigration that this guy is owing money. Other than that, if you are traveling, they don't even know. Me kokra, pack my things and left.
instead of like Commissioner informing immigration,
How will he know?
All the multinationals, so that when they are leaving the country, immigration can check it for him.
Yeah,
You can inform the Commissioner General that this person is leaving the country. Is everything okay? Can he or she leave?
Okay, Ruth, are you there? Ruth.
Yes, please. Yes, please.
Another form of avoidance where we normally call it closed companies. So we have undistributed profit, closed companies. Your husband, your wife, and then your 3 children, largely, or maybe not necessarily family members, but less than companies which are not controlled by more than 5 people. Typically, if you read the UK for the way they are, the way their own works, and they are mostly closed companies. Section 59 talks about taxation of shareholders. Okay, read section 59(1) for me, Ruth.
Section 59, subsection 1. Subject to subsection 3, a resident company which pays a dividend to a shareholder shall withhold a tax on the amount of the dividend.
Good. So if you are a shareholder, you pay tax. So if I'm a resident company and I'm paying the dividend to you, I'm supposed to take withholding tax at the rate of 8%. Okay. Come to subsection 3.
Subsection 3, a dividend paid to a resident company by another resident company is exempt from tax where the company that received the dividend controls indirectly or directly at least 25% of the voting power of the company which paid the dividend.
We are saying that normally, and again, Ruth, think about why we peg it at 25% whilst I explain. Normally, you have a parent company or somebody, an investor who has invested at least 25% for a company, or he controls 25% of the voting power. In other words, he's not a majority, but about 25%. So if that company receiving the dividend has at least 25%, then that 8% that you are slapping on the dividend should not apply. But please remember that company receiving a dividend must be a resident company. Okay. So I'm in Ghana, have a company, let's say MTN Ghana has Mobile Money Limited as a subsidiary. Because Mobile Money is owned by MTN, when Mobile Money Limited is paying the dividends, MTN has more than 25%, so the dividend will not attract a withholding tax. Remember, the dividend paid to a resident company by another resident company. So both entities are in Ghana. Don't go and exempt a company which is a foreign company, no. So if both paying and receiving companies are resident, and the receiving company has at least 25%, then the dividend is exempt. But this one is on equity alone. Look at subsection 4. Ruth, read the subsection 4 for us.
Subsection 4. Subsection 3 does not apply to A dividend paid to a company by virtue of its ownership of redeemable shares in the company that paid the dividend, or
Good.
B.
Okay.
Or B, a dividend that is the result of recharacterization under section 31 subsection 5 and 32 subsection 2.
Good. You remember we mentioned that the Commissioner General can recharacterize even a debt to equity. So if we do that recharacterization, we will not exempt you. The purpose of we exempting you is that probably you control a larger portion of the entity. And again, if you control that, we should not own 25%. We should not take that withholding tax from you, by the way. Do you understand? And again, the purpose is that when you receive that dividend, because you are also a resident company, eventually you'll be paying out to your ultimate shareholders, Meboa, Ruth. So I own you. Let's say you're a company. Then I have 25% in you. So you, Ruth, you'll be paying me dividend. When you pay me dividend, ordinarily you are supposed to take withholding tax per section 59(1). But then you because I have more than 25% in you, you will not take the withholding tax. You will not take the dividend, you will not take the 8%. Give me all the dividend. Me, I am the ultimate shareholder, and I'm the parent company. Eventually, when I'm going to pay the final dividend to, let's say, the class who are the individual shareholders, that dividend is now coming out. I think it's now coming out to the final people who are supposed to benefit it. So at that point, I'll take the dividend tax. Again, me, I don't know who said 25. Why not 10? Ruth, why not 10? Why not 10%? And at 10% is too low. Ruth.
Council.
Yes, dear. Let Ruth answer that question first for me, then you come in.
Okay. Okay,
Ruth.
sir.
To me, I think 25% can have an influence on the decision that they take as
Okay,
compared
24.
to 10.
Okay, 24. 24%.
So let somebody try.
Okay, so that's your homework. Go and find out why 25 and not 10.
Okay.
Certainly somebody suggested it could be a policy rationale. Me, I don't know, honestly. So come and tell us why. Maybe a lot of companies are doing 25. Sorry, a lot of countries are doing 25. That's why Ghana also decided to do 25. Sometimes when I sit down, I say, now the Ministry of Finance, why he's suggesting 3:1 and 25 and blah, 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 blah. Who is suggesting those things? Let's find out that. Let's go into the mind of that person. Okay, who was going to ask the question?
And it's me.
Mami.
Yes, Council, please. The issue about the ultimate owner and all that. Can you please take it again? I get the fact where as a resident owning 25% or more voting power, the dividend should be exempt from the 8%. You said if he pays something to others, then he can take it. That's why I'm confused.
We're trying to find out the policy rationale for we exempting that one. And I'm saying that if we exempt the guy receiving it, so assuming Mame is the shareholder of Francis, I also have 25% in Ruth. So when Ruth is paying me that dividend, Ruth will not take the withholding tax. But remember, eventually, when I receive that dividend, it's an investment. I invested it. But you are the ultimate investor, isn't it?
Yes. Yes.
So at the time I am paying you the dividend, that is where I'll take the withholding tax. You get a point?
Okay. Yeah. Okay.
Because you may not be a company. Maybe you are an individual investor.
Yes.
But Ruth is going to find out why this policy.
Okay, it will be on standby. I will do it for you to in class. Okay, I'll do it. Okay, all right. So thank you. Sorry.
But me is teaching someone too. Okay, let's move on. So we have seen this withholding taxes, that a dividend, when you pay it, you must blah, blah, blah. But let's come to subsection 9 or subsection 8, 59 subsection 8. Because, Ruth, are you with me?
Yes, sir.
Good. We are now going to see how we can also do tax avoidance using this particular one. So, Ruth, read 59.8 for me.
59.8. Where the Commissioner General is satisfied that a company controlled by not more than 5 persons and their associate does not distribute to its shareholders as dividends, a reasonable part of the income of the company from all sources for a basic period within a reasonable time after the end of the basic period, the Commissioner General may, by notice in writing, treat as dividend that part of the income of that company which the Commissioner General determines to be dividend paid to its shareholders during the period or any other period.
This is not fair, but we have to do it anyway. Ruth, where the Commissioner General is satisfied that a company controlled by not more than 5. Again, why 5? Research has shown that mostly these are called closed companies and their associates. 5 of them, they control the company. So when they pay themselves salaries and all those things, they are full. No need to distribute dividend for Commissioner General to get his what? 8%. Remember, they may have paid the corporate tax, they pay themselves salaries, blah, blah, blah. Everything is fine. All the taxes have come, but the Commissioner General is waiting for dividend tax. You can see they have huge retained profit. And they don't distribute the dividend. Because they are close or they are associated and they are not many, they don't bother. And if you don't distribute dividend, it's cool. Okay. They don't distribute the reasonable part of it. So if the commissioner sees that one, what will he do? The Commissioner General may, by notice in writing, treat as dividend. So with this one, we call it deemed dividend. You know, the fact that they are not distributing dividend means that they may be avoiding or postponing the dividend tax. Ruth, do you agree? You know, dividend
Yes,
is at the
please.
discretion of the directors.
Yes, please.
So they may be postponing or avoiding the dividend. And so if the Commissioner General thinks that, Charlie, more or too much accumulated dividend, who even invest in a company and grow the company without sharing some of the money for the shareholders? Why would you do that? So he will consider as dividend a reasonable part. He will treat it as dividend. And then he will take his dividend tax. And then go ahead and pay dividend. If you don't like, I may have taken my dividend tax. Whether you pay the net amount to them or not, it will be my problem.
What if there's no money to pay?
That's a very valid point. Who asked that question?
Ebenezer.
Ebenezer, it's true. So let's look at the solution in 9. Ebenezer, read for me. Read the subsection 9.
Subsection 9. The Commissioner General shall, in determining whether a company has distributed a reasonable part of its income from all sources for a basis period, consider subsection 9A, the current requirement of the business of the company after accounting for any adjustments which the Commissioner General may make under section 31 and paragraph 53 of the 7th schedule, and B, any other requirement necessary for the maintenance and development of the business.
So he's supposed to consider a lot of factors. For example, do they have cash to pay if they really want to pay? Why are they building up buffers? Why are they doing that? You remember in the banking sector, I think there was a Bank of Ghana directive that says that nobody should pay dividend, they should recapitalize. Even in the insurance sector, it came some time ago. You remember?
Yeah.
So they say don't pay dividend to your shareholders. Use it to recapitalize. So under that circumstance, it is a requirement necessary for the maintenance of the entity, and especially if it is a directive from the Bank of Ghana, because we need to make the company stronger. Come to think of it, it's capital maintenance and all those things. So what the bank did was that they transferred how do you people call it? Capitalization of profit. Maybe the accountants, Festus, where you move money from the retained earnings to stated capital.
Recapitalization.
Recapitalization. So instead of you paying the dividend to them, you recapitalize through retained earnings. And when you do that, the shares of the shareholders increases, isn't it? We normally, sometimes you even call it bonus shares, isn't it? Or it's accountants, they don't want to talk. Festus. Okay.
So,
We are you are accountant, you are the only accountant online, so we need your
oh,
assistance.
we are many. We are many. Oh, we are many.
Sir, who mentioned
We
what?
are many.
Is Krista an accountant?
I don't know, but there are many.
Gabriel,
So
are
we
you
can
back?
do that through bonus or right issue.
Right issue you pay.
Right. That's what I'm saying. I said we can do that through bonus or right issue. I thought you were
I'm talking
mentioning
about the one they
right.
don't pay.
Oh,
The bonus issue.
Bonus issue. Okay. What is the tax implications of a bonus issue? Let's look at subsection 5. So, Krista, are you one of the accountants?
Yes, please.
Okay, so Vida, we have been talking about bonus issue. We want to look at the tax implications. Assuming you are working in the bank, you are the head of tax, and then the Bank of Ghana has issued a directive. Nobody, because we want the banks to be more stronger. I think now their capital requirement is 400 million, isn't it? Krista,
Yes, please.
thank you. Let's talk. Now we are discussing bonus issue. And the accountants are saying that bonus issue is where they give you shares instead of them giving you dividend, instead of them paying you dividend, so that we'll take the tax, the dividend tax. We won't pay you dividend, but we'll give you shares. So if you had 1 share, your shares can go up to 5. If you have 10,000 shares, your shares can go up to 15,000. And they do that by transferring from the retained earnings to the stated capital. Then we'll tell you that, oh, Cresta, this year we don't have enough cash to pay dividend. And so we intend to capitalize through retained earnings. So henceforth, your 10,000 shares has gone up to 15,000 shares. Next time when we are paying dividends, we'll calculate it on your increases. In fact, you can even sell, if the company is listed on the stock exchange, you can sell your new 15,000 shares and make money and move. So what is the tax implication? What is the tax implication for this? Okay, so Cresta, read subsection 5 for me.
Subsection 5. Please, is it on the same 59?
Yes, 59.
Okay, so 59 subsection 5. A dividend is deemed to be paid to each shareholder of a company in proportion to the respective interest of the shareholder. If A, the dividend consists of profits which are capitalized, or B, the dividend falls under subsection 8.
Correct. So you see the word deemed. A dividend is deemed. Those of you who want to attend, I want to say something is deemed. So a dividend is deemed to be paid to each shareholder of a company in proportion to the respective interests of the shareholder if the dividend consists of profits which are capitalized. That's what we are talking about here. So instead of them paying dividend, they say, let's capitalize. Take some of the retained earnings and take it to stated capital. Then we'll determine how much shares each of you hold. And a typical example is what I said about the Bank of Ghana and then the National Insurance Commission. So I can ask you, what is the tax implication of this directive? And I'm expecting you to say something, to write. Krista, can you write? Who reads subsection 6 for me?
Sir, I'll read it. Godfrey.
Godfrey. Subsection 6.
Yes. Okay. But before I read subsection 6, I wanted to say that these things happen because probably they want to defer paying of the tax or paying of the tax from the dividend. So when they recapitalize, then at a later date, they may pay the tax.
Correct.
That is my
correct. You are right. But let's look at what the tax law sees it under subsection 6. What does it say?
Okay, let me read. Subsection 6. The Commissioner General shall, in the case of capitalization of profits, direct the company to pay appropriate tax in accordance with this act.
Yes. So you see, immediately the Commissioner General sees a capitalization of profits. Oh yeah, he will direct. He said, we have noticed that you have capitalized profit. Please come and pay the appropriate tax in it because it is a dividend. Forget about the fact that it didn't come in the form of cash. So he'll give a directive. Okay. But let's look at subsection 7 also, because it is not any circumstance. I think this is a very nice question to ask. Godfrey, what do you think? You set up a very nice scenario, okay? That the Bank of Ghana recently issued directive to banks, blah, blah, blah. The banks, the Bank of Ghana said don't pay dividend because they want to increase the capital structure. They want the banks to be stronger so that they can withstand DDEP. You see, they can withstand DDEP. The banks have therefore decided to recapitalize instead of paying dividends. What is the tax implications of this directive, and what advice will you give to the company as a consultant to minimize the tax implication? Read the subsection 7 and let's see.
Okay, subsection 7. The Commissioner General shall, in issuing directives under subsection 6, consider the matters contained in subsection 9 with the necessary modifications to make that subsection applicable to subsection 6.
Good. You remember the subsection 9 we read? The subsection
Yes.
9 says that when he's determining blah, 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 he must look at the current requirement, the business requirement, and blah, 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 all those ones, and then the maintenance of the business company. So I can ask you, the Commissioner General, the Commissioner General has, or the Bank of Ghana has issued a notice, blah, blah, blah. The banks even wanted to pay the dividend because the banks are weak and they don't have a big friends, and their balance sheet is not strong. They have to comply. As a consultant, we can even make it like they have even organized a CPD for you to come and talk to them about this particular thing. Write out your presentation. And what will you say? You understand? Will you allow them to go and pay the tax, or you make a special appeal to the Commissioner General in this case? Looking at subsection 7, will you ask them to go and pay even though the banks are recapitalizing? Geoffrey. Is it Godfrey or Geoffrey?
Godfrey.
Godfrey. Okay.
Yes, please.
Godfrey, what will you do? Will you advise the banks to go ahead and pay the dividend tax, or you want to take advantage of subsection 7 by appealing to the Commissioner General that, Mr. Commissioner, you know what? We know it's payable, but we want you to exercise your discretion under subsection 9. And so you know, we are supposed to pay it, but this is a requirement and blah blah blah. What can you do? Because he's supposed to consider certain things before he issued the directive, isn't it?
Yes.
So we appeal to him to stop, or he should postpone it. All right. Okay. We have spoken enough. We have any question? How many do we have now? It's enough, isn't it? Anti Avoidance Provisions. It's enough.
I said there's something I want to find out.
Yes, sir.
When they redeem the share, when they do the recapitalization, and the Commissioner General comes that they should pay the tax. Now, in that instance, who suffers the tax? Is it the company or the beneficiary of the bonus shares?
The shareholders. Here, see it here. Because the shareholder.
So at the end of the day, postponing it, I don't agree. Or postponing the payment of the withholding tax, I don't agree. Because at the end of the day, it has nothing to do with the company.
You are right, but it's the shareholders who are giving the money to the company.
Yes. So if you are enjoy the bonus shares, and they've asked you can go and look for money and come and pay.
Because to come and pay the tax. And you see, the reason why the Commissioner General will have to consider a lot of things is that it is the same company who must withhold the tax, isn't it?
Yes.
So imagine the company wants to do capitalization. It used to be 120 million, the banks.
Yeah, and now 400 million.
Cool. So from 120 to 400. Hmm?
But I said most of these banks are multinationals. They have money, and their shareholders
Banks.
Their shareholders are not poor.
Some of them are poor. In fact, you know, most banks went down, isn't it?
Yeah.
Because of
Now
capitalization.
we're talking about correct banks. We're not talking about the savings and loans. We are talking about the big boys.
Yeah, but even if you even go in by the big boys, we have some banks which went away. A friend is saying, Agongo Bank, and what's the name? There was the Energy Bank.
And
I mean, so you remember the financial sector cleanup?
Yeah.
Yeah, some of the
the
banks,
Heritage Bank.
Heritage Bank.
Okay.
Yeah, some of the banks were there, but they were not strong enough. The reason why they went away was that their balance sheet was not strong and they needed to recapitalize. So imagine the bank itself is suffering and you want them to bring part of the retained earnings to come and, beef up. Don't you think that it would be good to suspend the tax? At least the tax can even come and top up the recapitalization, or you don't agree?
I don't agree, because at the end of the day, it's the shareholders who are going to pay the money, who are going to pay the tax.
Who is bringing the money?
I said they are recapitalizing the retained earnings, and
So
they were supposed to pay to you as dividend.
It's for which people? The retained earnings.
Shareholders.
Correct. So we are saying that it's for the shareholders. So if it is 10,000, we are saying that we need more money. So let's use the entire 10,000 to recapitalize the company. Now the taxman say, no, you can't use 10,000. I'm coming to take 8%. So you can use 9,200. Then the law says that, Commissioner, if you are issuing that directive, come to section 9, subsection 9, and consider certain things. So if you're a consultant, won't you make a case for your company, for your client?
You make
yes,
a case.
Yes, we'll make a case.
You make it, but from the Commissioner General's point of view, or from the taxman's point of view, they should still pay the money.
So they say section 9, no, even though he's the Commissioner General shall in determining whether a company no, where did I go? Let me go to subsection 6. Was it 7? The Commissioner General shall in issuing directives under subsection 6. This directive. Shall in issuing what am I reading, crap? The Commissioner General shall, in the case of capitalization of profits, direct the company to pay appropriate tax. Now, 7 says the Commissioner General shall, in issuing directives under subsection 6, consider matters contained in subsection 9. What is he going to consider? So he considered and he realized that if I issue this directive, there's going to be a problem with maintenance and development of the company. Must he go on?
Yeah, so hello, sir.
Benedict.
Yes, so I think this scenario will be one of the factors that the Commissioner General will have to consider. My understanding is that, I mean, the reason why they are capitalizing, the intention is not to avoid the payment of tax, but to achieve certain ends. That is the capitalization of bank, or increase in certain capital from 120 million to 400 million. And so if the profit is being capitalized to achieve that ends, the intention is not to avoid tax. I think this scenario will be one that the Commissioner General will have to consider. Correct. And allow the company to do so. If you compare this one to a company where there's no pressure on them to increase stated capital, but the company is capitalizing just to avoid tax, then the Commissioner General will have to write to them to come and pay the appropriate tax. And so the scenario that you just painted in terms of the banking capitalization would be one of the areas that I think that the Commissioner General would allow. I mean, would allow the capitalization without issuing then the directives come and pay tax. That's my thinking.
Great.
Yes, I
Level-
know whether that situates well with the law. I mean, if you can.
Sorry.
I'm saying that this is my thinking. I don't know what you think.
No, you're right. So the Commissioner General is supposed to consider a lot of factors. And one of them is what you have raised.
Right. So when he's
Mhm.
capitalizing the income and the profit,
Mm.
does that attract as stamp duty?
Yes, stamp duty, stamp duty is not under Income Tax Act.
Oh, okay.
Stamp duty is under the Stamp Duty Act, but you are right. There will be stamp duty. That one will be collected by Registrar General. I don't think they have any discretion to do. They will collect their money. 1%. It should be 0.5%.
Okay. Thank you, sir.
Let's pack the anti-avoidance. I'll send you some questioning. Try your hands on them. Let me see how you feel. I'll just give you some scenario questions to try your hands so that it will help you understand. It will help you understand some of the anti-avoidance. Please, you need to do your best to answer them for me. Are we on the same page? On the same page?
Yes, sir.
Thank you.
Yes, sir.
All right. Let me start something. I'll close. We have a meeting at 6. I'll close at I'm looking for some article I wrote. I'm not seeing it, but I'm going to share with you. Let's look at the tax planning when it comes to the type of business. I think the examiner it's also another area that we like examining. Okay. When it comes to the type of entity to set up. When we are looking at taxation, should I set up a sole proprietor, a company, or a partnership? I want to chip in. I want to chip in this one because largely we have finished with section 59. So you know how taxation of individuals and taxation of shareholders are, isn't it? Those of you who have been studying the past question, you will notice that sometimes we ask questions on Kofi wants to set up. He came from United States. He wants to set up a business. He's contemplating which of them will give him the most efficient tax, savings, or the one that will give him the least tax. Advising. Okay. I did this in tax planning for small businesses, choosing the type of business. I'm looking for the soft copy. I can't find it. The Word document. Can you see my screen? Can you see my screen?
Yes, please.
Good. So again, I'll look for some of the questions for you that try to examine the students on this one. If it's too cheap, but I think we still need you to understand the tax implications of the type of business. Maybe we can make it 10 marks or 5 marks or whatever marks. It cannot be 4 marks. And then we see how we can blend it with other concepts for you to be able to understand. Because largely, you don't just get up and say, I'm going to a company. What are the tax implications if I set up a company? Especially since we have also introduced the growth and sustainability levy. Okay. If you are an individual, there's a way you are taxed. If you're a company, there's a way you are taxed. And when a company is taxed, we also tax the shareholders and the partnership also you are taxed. Have you done partnership taxation in advanced taxation? Have you done
No, sir.
Not yet,
Okay, who is taking you advance?
Mr. Logo.
Okay, sir, logo. Okay. I'm sure you do taxation of partnership. So watch that one out. It's also an important topic, especially for consultants. Most of you, when you finish, you go and set up your partnership fund. Maybe Ruth and Vida will team up and set up Ruth V tax consultant or tax partners. How do we tax them? So let's look at sole proprietor. What are they? First of all, you should be able to explain. If we ask you to advise, let's say, Francis, about the tax implications of the various type of businesses available for him to set up, you should be able to advise him. So you start by discussing what a sole proprietor is, how are sole proprietors taxed. Because you are advising me, I just came from US and I have a lot of dollars. I want to set up a business and I've come to you. Advise me. Okay. That's what we want to look at. Okay. So we all know that if you're an employee, employment is just to sustain you. But if you want to really make it, but by the way, some of the employment too, if you get to the top, even though very few people get to the top, if you get to the top, is nice. So they pay you nice. Your car, fuel, everything is given to you, but very few people get to the top. Majority of them are at the bottom. So doing your own business is very good. But for us tax professionals, we will normally want to look at the most appropriate. Okay. I haven't looked at the legal and the tax consideration. Okay. And the question will be for you to assess the tax consequences of doing the most common type of businesses. So we will expect you to start from a sole proprietor, and we all know what a sole proprietor is. Okay. And sole proprietor, we say you do the business alone, operated by one person. Two people cannot do sole proprietorship. Okay. If you look at the Business Names Act 152. Is it 152 or 151? Partnership is the 151. So you do it as an individual. In terms of registration and everything, it is very simple and it is common in Ghana. Okay. It's very common. And you are not separate from the owner. You are not separate. That is why, for tax purposes, if we are assessing a sole proprietor, we assess him as if he's an individual. In fact, in law, the sole proprietor is the owner, and he is the same person. You are not separate from the owner, and that's why we call you are the proprietor. Okay, you are not like a company. So the business is the same as you, because all the income and all the assets and everything belongs to you. When it comes to the tax law, you, the individual, you are the one we are assessing. So we assess you from income from business, income from employment, and then income from investments. And so the profit is taxed in your hands as the owner. Okay. Are we on the same page? Assuming you are advising me, maybe the benefits will be that, well, it's very simple to operate, and I don't need too many legal requirements. Registration is very simple. I just pick some forms at the Registrar General. Nowadays, if you want to register a company, the kind of trouble that you have to go through, sometimes it's not easy at all. Okay. So when it comes to the legal requirements, it's so simple. When it comes to taking decision, you are the only person. But the disadvantage is that when you die, the business is dead. Your children cannot even continue. Unless maybe they go and register a similar one. The asset, of course, the buildings and other things will be there after they have done your letters of administration or your will. But legally, the business is not theirs. In fact, you only register the name but you are trading as you. So if you pick an individual tax file, you see Cresta trading as Christabel Enterprise, Ruth, I've even forgotten your other name. Ruth Beju trading as so and so. That is how it is. Okay. So you are the individual. Now, you have to go through this particular analysis because you are advising me. Tell me the advantage and blah, blah, blah. Simple to start and blah, blah, blah. But remember, you are just advising. So maybe not too much of a detail because we need you to look at the tax implications. The next most important business will be partnership. And under the Partnership Act, not more than 20 come together to do business. There can be professionals or any. Okay. Again, when it comes to the law, the partnership, you have to register it. Okay, you have to register it with your partners. There must be partnership agreements and all those things. There's a separate law, section 53. Sorry, section 52 to 55 deals with taxation of partnership. I wouldn't want to go in there because Selogo would treat that part with you. But for you, there's simple tax implications of the various forms of business. A simple reading, understanding that it is not more than 20 coming together to carry on business with the aim of making profits. And some of the benefits will be that because you are pulling more members together, you have access to a pool of funds and also expertise. Okay, because the different people coming together will bring in some different skill sets that will help the business to grow. The major disadvantage is that you have unlimited liability. So one person commits a mistake and it almost like affects everybody because you are jointly and severally liable for each person. When it comes to the taxation of, and this is where you have to now narrow down. When it comes to the taxation, the partnership firm does not pay tax. The partnership does not pay tax. Let's read section 52. Geoffrey, have to do as they are now.
Sir, okay.
Section 52 says what?
Section 52, Principles of Taxation.
Mhm.
1, a partnership is not liable to pay income tax with respect to the chargeable income of the partnership and is not entitled to any tax credit with respect to that income.
Good.
But the partnership is liable to pay income tax with respect to final withholding payments.
Good. So the basic principle is that the partnership, please, we are not talking about partners. So the partnership firm that you guys have registered is not liable to pay tax. Why? Because the chargeable income will be distributed and shared among the partners. When I receive it, and here, Selogo will teach you very well how the calculation is done. When I receive the money in my hands as a partner, then we come to section 54, taxation of partners. Because they've shared the profit, and those of you who did accounting, because they've shared the profits, at the end of the day, the profit will come into my hands. And when I receive it as an individual. When I receive it as an individual, it means that I can now be taxed as an individual person, just like a sole proprietor is being taxed. That's the principle. Please, are we on the same page? Hello?
Yes, sir. Yes, sir.
Yes, sir.
Okay. So having laid down the basic foundations, now you have advised me what a partnership is. I cannot do more than 20. The partnership is not taxed, it is taxed in my hands. You also have to take a look at the company. These are the most common forms of business. Take a company and you discuss what a company is. That is a creation it's a creation of law. The lawyers, any lawyer online, I always think that this is a fiction. Why do they say a company is a separate legal entity? It's an artificial person, yet it cannot do things by itself. The Solomon principle. It's a fiction, actually. Because a company cannot be a human being. A company cannot be a person. But we have believed it so well over the period. So discuss the company as another common form of business. Okay, and it is separate from its owners. It has to be registered. So the company has its own thing, and the shareholders also have their own. So a company is taxed separately from what? A shareholder. Okay. Let's go to section 58. Can somebody read section 58 for us? I'm showing it on the screen. Section 58.
So I'll read.
Okay.
A company is liable to tax separately from its shareholders. Subsection 2. An amount derived.
So you see, the first principle is that if you're a shareholder, we'll tax you separately. And in your analysis, you need to bring out all these things. So in fact, if you are discussing a company, even though I'm giving you the general principles, you must reference me to section 58 if you are discussing company. You must reference me to section 59 if you are discussing shareholders. You must reference me to section 52 if you are discussing partnership. Okay. We are discussing all those things. Go ahead. 2. The person reading. Person is off.
Sorry, sir. So I'm here. An amount derived and an expenditure incurred jointly or severally by the managers or shareholders for the purpose of a company is deemed to be derived or incurred by that company, even when that company lacks the legal capacity to derive that amount or incur that expenditure.
What does that mean
3.
to you? You lack the legal capacity to acquire, but we don't care. Is it fair?
No.
Well, the lawyers will say if we don't introduce some of these clauses, people will set up an illegal company, make money, and then they will come and argue on the basis of illegality and avoid taxes. So why would you tax people who are obeying the law and then exempt people who are not obeying the law? If you're a tax policy expert, will you do that? Is it your free reading?
No, it's a Ben is a lie.
Ebenezer. So you realize that you cannot.
Yes,
So
please.
whether you have the legal capacity or not, then we tax you. In fact,
Yes.
the debate over whether illegal income or assets should be taxed is something that appears to have settled. But me, I have issues with it. Doesn't mean that if people embezzle money, we should tax them. Ebenezer, Public Accounts Committee, those who have embezzled money, should we tax them?
Yes, please. We should tax everybody.
Oh, it's like a business cow.
What's in this car? You have to tax them.
Oh, we'll talk about that one when we
Okay,
are
sir.
discussing. But continue.
Okay. An asset owned and a liability owned jointly or severally by the managers or shareholders for the purpose of a company is deemed to be owned or owned by that company, even when the company lacks the legal capacity to own that asset or owe that liability.
Continue.
4. Subject to this act, all activities of a company are treated as conducted in the course of a single business of that company. 5. Subject to this act, a person shall give effect to an arrangement between a company and a manager or shareholder of that company. Yep.
Okay. So, and I think we are done with shareholders. So the
Yes.
area that I'm discussing with you now, I need you to look at it from a sole proprietor point of view, an individual. If you're an individual, whether you are doing a business or not, will tax you as you are an individual. When you get to partnership, come and make reference to the law, okay, and the partnership section 52. Now you come and now focus on the tax implications for establishing the various forms, and this is where your analysis will have to come in. You need to state the fact that a company is taxed separately from the shareholders. And this, Ebenezer has read it from section 58(1) for us. Okay. Currently, the corporate tax rate is what? 25%, isn't it? And then they are supposed to pay growth and sustainability levy of how much? 2.5%, making 27.5. And now, then after the company pays its tax, the money must now reach the people who invested the money in the company. So dividend to be paid to the shareholders at the rate of how much? 8%. So what do you think is the potential total tax if one decides, if one guy, so assuming me, I'm a poor guy, I come from US, what do you think is the potential tax exposure if I decide to go for a company? Like that. So, Benedict. Sarah, I've not heard your voice. Sarah,
About 33%.
it should be more than that too. Add all of them together. How did you get a 33?
25 plus 8% on dividends. Okay, if I add the sustainability 2%, that would be
25.
4.5.
Sustainability is how much?
2.5, depending on what.
2.5, that would be about 35.5%.
How much? 33.5.
35.5,
Okay.
I think.
Potential 35.5. So you need to bring out this analysis, but you need to distinguish them. You know, the bases are different, isn't it? So is it true that companies are double taxed if I invest in it? If I'm an individual, who was speaking? On to was it who
Benedict.
was sorry?
My name is Benedict, please.
Benedict. Forgive me, I'm trying to capture the voices so that when I meet you in town, I'll say, Benedict, you are Benedict. Not normally like online. Sometimes someone will meet you in class. In town, no about it, then you'll be standing there looking at the face as if. So forgive me, Benedict. So, Benedict, if you are an individual, what is the maximum, what is the highest tax that you pay as an individual? We'll use the graduated rate, isn't it?
Yes, sir. Graduated rate.
Correct. And that is 35%.
That's correct.
So it looks like, okay, let me ask this question. Individuals don't pay, sole proprietors don't pay growth and sustainability levy, isn't it? Does it apply to them?
No, it's not applying to them.
Okay, so does it mean that it is a bit okay to go into sole proprietorship business than company? Does it suggest so?
Hello, sir.
Yes.
Please, can I come in?
Come in.
Please, my question is, if you look at the three type of business, so proprietorship, partnership,
and the company. What we get to understand now, it seems partnership in a way doesn't pay much taxes compared to company and then individual businesses.
Hold your thoughts there. Hold your thoughts there. You remember your colleague read that partnership does not pay tax, but when we have finished, we share the taxable profits and give it to the partners. Section 54. And then the partners are the one who pay the tax. So the partners are treated as individuals. If you are a partner, you are an individual, remember?
Yes.
Good. So partners and individuals are likely to be in the same
tax.
Income bracket. Remember?
Yes. Yes.
But I want you to look at something very well when it comes to non-resident partnership. Can a partnership, can a non-resident person be a partner? Who was talking?
Yeah, that one sure, depending on the regulation governing that particular business the person is coming to do.
Okay.
Since we have foreign direct investment in Ghana, and the law requires that they have to get certain Ghanaian to partner there before they can enroll on that particular business.
Okay, but Kweku, assuming that we are even, can you form a partnership with your US colleague, or let's say a Ghanaian, but he is not tax resident in Ghana, or not your broche? He looks for the job and then and remember, partnership is not just limited to consultants, can be anything business. He is not in Ghana. Your other partner is in the, he will be bringing used cars. He can still be a non-resident and be part of the business, isn't it?
Yes.
Yeah, that was sure.
So he becomes a non-resident individual.
Yeah.
When after we have shared the profit and we have given his own, because when we share the profit, the money gets to the hands of the partners, and now they take on the identity of an individual, isn't it?
Yeah.
Yes.
And then we have to use the graduated rate per section 54 of the Income Tax Act. It is the partners who are taxed. So, if that's the case, there's that possibility that we can have a non-resident partner who will pay tax at the rate of 25%. What's the rate of non-resident individuals? Is it not 25? Again, if you go and read section 133, partnership appears to include a corporation or a company. So there can be a company who is part of a partnership. Read section 133 for us. Look for the meaning of partnership. Who has it? Are we online? Some people are quiet too much for my liking.
Okay, sir.
Yes, sir. Partnership.
Okay, let me read. I have it.
Okay.
Partnership means an association of two or more individuals or corporations carrying on business jointly for the purpose of making profits, irrespective of whether.
Did you see corporation there?
Is there? Partnership means an association of two or more individuals or corporations carrying on business jointly for the purpose of making profits, irrespective of whether the association is recorded in writing.
Correct. So see the word corporation there. So it looks like a company can be part of a partnership. If it can be part of it, then when we share the profit and the company receive their share, the company is now a partner. And the company will now have to go and pay tax according to its status. Okay, so I need you to look at it from, put all the taxes together, and then you can now advise which of them gives the minimum. At the time I wrote this article, I concluded that individuals appears to have the lowest tax. As at that time, now the growth and sustainability levy has not come. So my judgment is flawed. Now we now have growth and sustainability levy. The graduated rate has also gone up. But remember that one is 50,000 and above, isn't it? The graduated rate. Meboa. Guys, are you with me? The individual graduated rate, is it not 50,000 above that attracted 5%?
Yes, that's the last one, 50,000
Aha.
and over.
So your analysis, you have to consider it. But if I'm a company, so be careful the way you conclude. If I earn 30,000 or 20,000, okay, if I earn 20,000 as an individual, I will not pay 35%. If I'm a company and I earn 20,000, I'll pay 35.5% potentially. So consider all the tax exposures, consider the shareholders, consider the partners, the partnership, the individual partners, the non-resident partnership, the possibility of a company being a partner, and then advise the burger which of the companies or which of the business units has the minimum tax exposure. Any question? I would like to end here.
Sir,
Yes,
sir.
sir. Yes, sir.
Yeah, per the discussion we have had now, it seems to me that there's not a standard type of business that we can say that as for this, the tax implication is more favorable than the other. It depends upon the way you argue.
No, Godfrey, these are laws. So you should argue. Your argument should be based on the law and it should be as it is. In fact, if you sit down and put it together, of course, you are looking at potential exposure. It should be sound. You have concluded that the growth and sustainability levy doesn't apply to individuals. Maybe why?
Yes.
It doesn't also apply to partners because they are going to receive the money as individuals. So then potentially company still appears to be the largest. Or
the last time one of our lecturers was saying that it looks as if now registering a company is far better than going into either sole proprietorship or partnership business.
What was his argument?
No, we didn't have the opportunity to ask for the argument, but he made it in passing.
So now you have the basis. So when he makes that case, he said, "Sir, let's analyze the issue. For individuals, before you can pay 35%, you must be within this income bracket. For partnership, you must be within this income bracket. If in partnership, please go ahead and make a case for non-resident partnership. Do you remember non-resident partnership? They don't do 35%, Meboa.
No.
Sorry, non-resident partners. Sorry, forgive me if I use partnership. We have established that partnership don't pay tax. Non-resident partners, no matter what the income level, do you know they won't apply 35%? Sorry?
It's 25%.
Correct. So, under that circumstance, you have to make a case that non-resident partnership even gives a better tax opportunity than a resident individual or partnership or company. You need to digest it with supporting evidence from the law. Then you can even talk about, when you are even discussing partnership, talk about the corporation that they have put in there, that the definition of partnership. Look at the corporation they put there. Because you can't also just conclude partnership is the best. You can't conclude that. Isn't it? Because if a company is part of the partnership, it will still come back and still apply the company tax. Go for it.
Yes, sir.
So please, I will leave you to analyze. I've shared the article on the page. This was an old article, but you can follow the thought pattern and come up with a better conclusion so that next week,
Sure.
I'll share some questions, past questions on this one for you.
Okay.
So we are done with tax avoidance. We are done with the forms of business and their tax implications. We'll continue next week. Have a wonderful. Yes, dear.
Sir, please, I didn't join any. Is it possible we'll get the recording so that I can follow?
With Bonzi. Oh, you were cooking palm nut soup. You have to promise to give us some before we'll give you the recording.
Okay, I hear.
Yes, sir, we will give you some.
I'll post it for you. I'll post it on the page. I think I saved it somewhere last week. Was it last 2 weeks or whatever? I posted it there, so you can go on that. Anyway, let me just recheck it again. Why? Okay. And then just on the same point, I will be doing some recording, short one, 30 minutes. I know if I do long ones, you people will not listen. I'll do short ones on some of the topics. Then you can listen. So when we come to class, I won't spend much time. You will just be asking me a question, then we'll move on. So whilst you're at work, you can use your earpiece and listen. 30 minutes maximum. Then we can be covering some of those stuff. And then over there too, I think I can move faster because nobody's asking questions.
Okay.
Thank you, sir.
Have a very wonderful evening. Bye-bye.
Bye.
Bye. Thank you.